Hims & Hers could be one of the best stocks to be holding in 2025. In this video, I'm going to be showing you why exactly I think this. So kicking this off, Hims is up 197% on a year chart. With it peaking in December and the current price being set at $25, we can see a PE ratio of $57 and an earnings per share of 0.44. This PE ratio shows that analysts are actually, and investors are actually, hedging their bets with Hims & Hers. They're pricing a lot of growth into this stock, which does have its reason for sure. In the last quarter statement for third quarter 2024, we saw a year-over-year growth of 77%. And in Q2, it was 52%, in Q1 it was 46%, and Q4 of 2023 it was 65%. So we are seeing a steady growth within this sector for sure. What is Hims & Hers for the people that don't know? Hims & Hers are a wellness brand that offers a variety of health and personal care products focusing on areas like sexual health, hair loss, skincare, mental health and more. They provide prescription medications, over-the-counter products and wellness resources through telemedicine models, allowing customers to consult with healthcare professionals remotely. Both brands of Hims & Hers aims to make healthcare more accessible and affordable in a discreet way through an online platform. So looking through their quarterly earnings reports, we can see that there is a lot of growth still yet to come within Hims & Hers for sure. On the other hand, I don't want to be too biased. Here it says the stock currently looks expensive. We've used price to earnings ratios in this instance because there's not enough visibility to forecast its cash flows. The stock's ratio of 60.74x is currently well above the industry average of 21.99x, meaning that it is trading at a more expensive price relative to its peers. Which I do agree with. It is definitely trading much more higher than its peers. However, I think with the growth being so exponential with Hims, I think there is somewhat of a reason for this. I do think a lot of analysts aren't actually pricing in a large amount of growth for Hims & Hers at all. Despite that, I do currently think that the stock is at the moment overvalued, but I do think hence the PE ratio being 57, I think if you were to buy in now and hold for a year or two, I still think you're going to see good returns off of this. With analysts only expecting a return of 12.64% in the next year, I personally think that is completely wrong in my opinion. I think that is way too low based off of what we've seen from the past. Furthermore, this past is showing no signs of slowing down either. With the current year being 287%, I really struggle to see how they've jumped all the way down to 12.64% next year. In this instant, next year is saying it is 2025, so it is actually this year. So now we're going to take their financial data and put it into my system. Luckily, I've already done it. So starting off, looking at the liquidity ratio here on the far left, we can see that in the past 5 quarters, Hims has done exceptionally well with their liquidity ratio being 22. That means for every dollar of debt, they have $22 of liquid cash to pay this back in, which is exceptionally strong, as typically you'd want to see this around 1 to 2. This could be for a couple of reasons. One being the fact that Hims is not a face-to-face company. It is a contactless company, meaning that they don't actually need much infrastructure in order to complete its operations. It is primarily online, as it is an e-commerce. Of course, they do over-the-counter prescriptions, but that is already built in place. It's just a third-party pharmacy in which they will use. Trendlines are expecting this liquidity ratio to only get better as well, with the total debt seeming to plateau whilst total cash is actually growing somewhat. So now taking a look at the retention rate here, again, very impressive with them actually breaking profit in this quarter here. This was 4 quarters ago, meaning it was Q3 of 2023. We can see here that the retention rate is currently at 18.8%. Which is absolutely amazing for a company in which was founded in 2021. So that is quite exceptional to be honest. Furthermore, trendlines are expecting us to only get better and better. I think, again, this retention rate is due to the fact that it is primarily an e-commerce company. It's similar to why Warren Buffett invests in companies like Treyarch, which make video games. It's because once the software is up and the system is running, it runs itself essentially. Of course, there is the difference of the fact that Hims & Hers does have a lot of R&D and a lot of stock holding, but aside from that, there isn't really much running cost for a company like this. So now taking a look at the free cash flow, this is just only getting better and better as the quarters go on. So again, nothing to worry about here. This will be used for paying out dividends in which they don't pay out, paying out debt in which they're perfectly fine with doing at the moment, stock buybacks, which they potentially do. Again, this is just looking really positive. Ideally, seeing a positive free cash flow is really good, as it means that this company isn't at risk of just going bust all of a sudden. So your investment has some sort of safety with it. So looking on a 365-day exponential chart here, we can see the trend line is projecting the price to just increase. Despite this, we have actually seen a decline since December, as I mentioned at the start of the video. I don't know how long we will see this decline last for. I do think that the stock is currently slightly overvalued, like I did say, but nonetheless, I do think long term this stock still has a lot of growth in it. But I think we will see this start to fall off, maybe towards the $20 mark, maybe not that low, but I think we'll see it fall off for a while, maybe 1 to 2 months before it starts growing again. With a lot of volume in this stock, it's certainly one with a lot of volatility. Looking at the 91-day exponential chart here, we can see it's a very similar story again. So looking at the figures, we've got a P/E ratio, of course, at 58.16, a 52-week high of $35 and a low of 8. This being a difference of $26 with a beta rate of 1.3. That means on a volatility scale, we outperform the NASDAQ 1.3 times, which at the moment for the last month has not been a positive thing, as the stock has just continued to decline. Furthermore, the price is currently at $25, so we're about $10 off of the peak. So this is where it gets interesting. Looking at Graham's formula here in these two charts, we can see the left original and the right revised. So judging by its quarterly earnings report previously gone by, I've put the growth rate here at 77% with the current EPS at 0.44. This gives us an intrinsic value of $65 on the left with a margin of safety at 75%. This gives you an acceptable buy price of way above where we currently are at $49, this allowing for a massive return. Again, this earnings per share growth rate here is just what I've put in myself. The analysts actually project this to be 12%, of course, which would actually give you an intrinsic value of $13, which I just personally do not agree with at all. So let's change that back to 77. So on the right, despite this 77% growth rate, we're actually still seeing an intrinsic value of $33 with a margin of safety at 75%. This gives you acceptable buy price at $25.41, which is exactly where we are. So it's saying sell here, but realistically it would still be a buy, as there is with the margin of safety room for growth within that. So I think with that being said, it is definitely a good stock to be holding. Let's move on to Peter Lynch's value here. This takes into account the growth as well as dividend yield and the PE ratio. This gives you a result of 1.3, which means that the stock is currently fairly valued, which according to the revised formula just then, which is very true. And I would definitely agree. Earlier on in the video, I did say that I do think it is slightly overvalued at the moment, but I would like to revise that and say it is fairly valued. I do think with the potential growth in the future, there is definitely room for this to grow. The stock is definitely not undervalued, let's put it that way, but I think hence the strong P ratio of people putting money into the stock at 58 times earnings. I think that there's a lot of potential with this stock for 2025. With that being said, though, I do think we are going to see a bit of decline in the market just in a broad term for the next month or two. So it will be interesting to see when a good time to buy into the stock is. With that being said, let's actually try and figure that out now. So using the indicators, the MACD trend lines here, we can see that we are actually just entering a short position within hims and hers. So typically right now, you would not want to be investing into the stock at all. So if we put on a 50-day moving average here, whereabouts are we? So we are actually below the 50-day moving average, which is very bearish currently. So as I literally just said, I think we're going to see a downward spiral for this stock for 2 months. I don't think it's going to be massive. I think If you do hold the stock, put a stop loss in. Of course, you should always have your stop losses in. But I think we're going to meet the support. Let's see where the support is with this stock. So we are currently on the support according to this, but I don't think that is particularly true. I think a more general support would be around the $20 mark, which I said earlier on in the video. I think we will reach $20 before this stock starts to climb back up again. But if you do currently hold this stock, please, unless you bought in at the peak, please do consider still holding this stock, as it's not the end for this stock at all. I think this is just the beginning. I think this is going to have a great this year. Of course, in line with the broader market movement. For me personally, I'm either going to wait for this support to be hit before I buy into HIMS stock, or for this position to turn into a long, which I do also think will be around this point here. When we compare its earnings per share to its peers here, again, we are massively above the competitors, which goes back to the article I read earlier where it said that we are massively above the competitors, and it didn't actually tell you the reason for why. It's just because the growth is way more exponential than we're seeing elsewhere within that sector. Same again with revenue growth compared to the peers. In fact, a lot of these, the average is actually set at 7.53%, and this is actually carried up massively by HIMS. Despite this, their growth is at 77%, which is what I put into my system earlier on in the video. When looking here on the right, we can see that they've also put HIMS at a hold, which I would definitely agree with. I do think HIMS is a good stock to be holding long term, but if you don't currently have HIMS stock, I would personally try and time it slightly better, maybe giving it 1 to 2 weeks to months to actually wait to buy in. The stock is currently fairly valued, but I do think it's going to have a lot of growth in the next year or 2 or 3. I think it's in a very similar position to SoFi, where it's just outperforming its sector due to its uniqueness. So with that being said, I'm going to end this video here. I hope you have enjoyed this video or found it somewhat useful. Please do leave a comment on your thoughts on this stock. Will you be buying, selling, or holding? And with that being said, I will see you for the next video.